Hello everyone. Today we are going to talk about finance. First of all, what is the meaning of finance? Finance is the art and science of managing the money. When you manage your money, it is a kind of art, and when you manage your money systematically, it is called a science. So, finance is the art and science of managing your money. In the business, in the finance subjects, we use the term business finance. What is a business finance? Money or funds available for a business for its operations is called finance. The money which you need for carrying out your business activities, your business operations is called finance. It is required for the survival and growth of the business. It is required for the production, for the distribution of goods, and for meeting the day to day requirements, day to day expenses of the business. Now, next is why business need finance. We need finance to start any business. You need money for starting any business. Next is to meet your day to day expenses, to expand the existing business by making new products or entering into the new markets. You need finance to tackle the future business uncertainties. Any kind of emergency, if you want to face, then you need to have finance. Next is to face the market competition. Next is what are the various sources from where we can raise the finance. These sources of finance has been categorized in on different basis. What is on first is on the basis of time. On the basis of time, the sources of finance can be short term or it can be a long term. Next is on the basis of ownership. There can be a owner's funds or there can be a borrowed funds. First is on the basis of time. On the basis of time, finance can be short term, it can be medium term or long term. Short term finance means when you require finance for a period of 1 year or less than 1 year. For example, trade credit, cash credit, bank loan, etc. Medium term finance is required for more than 1 year but less than 5 years. Examples are medium term bank loans, preference shares, debentures, etc. Long term finance when you need finance for more than 5 years. Example equity shares, preference shares, term loans from the banks and financial institutions. These are the various sources from where a business can raise a long term finance. Next is on the basis of ownership. It can be owners' funds, that is, you can raise the funds from your equity share holders by issuing the equity share capital, preference shares, or retained earnings. It can be borrowed funds. Borrowed funds, it includes loans, debentures, etc. Now, there are various other sources of finance which are available for the startups, for the entrepreneurs. It can be internal sources or external sources. Internal sources means the sources within a business from where you can raise a finance. These are the personal sources of the entrepreneur, that is a founder finance, or you can use your retained profits. You can uh, take finance from your friends or your family. Next is external sources. The external sources includes bank loan, bank overdraft, and loans and grants. Now, finance is a very important function, and the person who manages the finance in your business is called a finance manager. So, the various functions that a finance manager is supposed to do, it includes forecasting the financial requirement, means predicting what is the level of finance the business may require. It includes financial planning. They need to plan the finance, where to use the finance and how to use the finance, procurement of the funds from where we can procure our funds, allocation where we need to allocate the funds, and for distributing the profits in the form of dividend, That is a dividend decision that is to be taken by the finance manager. He is to maintain the liquidity of the business. He is to evaluate the financial performance of the business, and the surplus that a business is having, the finance manager has to ensure the proper utilization of the surplus. Thank you so much for watching my video.